Section 1. Ancient Beginnings, Bartering and the Birth of Currency. Imagine a time when human societies were just forming. People traded goods and services directly. They bartered. This meant exchanging one thing for another without money. For example, a farmer might trade grain for tools, a potter might trade pots for cloth. But bartering had limits. Not everyone wanted what you had, making trades difficult. People started using valuable items as a medium of exchange. These items were the first forms of currency, simplifying trade. Early currency included shells, beads, and salt. Later, gold and silver became popular due to their value. These metals were durable, divisible, and rare, ideal for currency. Currency made trade easier and more efficient. It allowed for complex transactions and larger-scale trade. People could specialize in producing certain goods or services. This led to economic growth and the development of early civilizations. Trade routes connected distant regions and fostered cultural exchanges. Merchants and traders transported goods and currency across distances. Cities grew into economic hubs, evolving currency use. From these beginnings, currency has shaped modern trade. The evolution of currency reflects human progress and adaptability. Section 2. The Rise of Trade and Early Currency Exchange. As civilizations grew, so did trade routes. Merchants traveled vast distances. They carried goods and currencies from different lands. This led to currency exchange. Temples and money changers facilitated these exchanges. They assessed the value of currencies. They charged a commission. These early exchanges were basic, but they laid the groundwork for modern Forex markets. Section 3. Amsterdam, the cradle of modern Forex trading. Let's explore the origins of modern Forex trading in Amsterdam. In the 17th century, Amsterdam became a global trade center due to its strategic location and innovative spirit. The Dutch East India Company, founded in 1602, was key in international trade and financial market development. It brought in goods and currencies from around the world, creating a vibrant marketplace. This trade led to the first formal foreign exchange market in Amsterdam, essential for business. Merchants met to exchange currencies, vital for international trade. They set exchange rates based on supply and demand, laying the groundwork for modern Forex. The Amsterdam Exchange inspired other financial centers with its innovative practices. It established principles like open outcry trading and price discovery, shaping today's Forex markets. Amsterdam's legacy emphasizes transparency and efficiency in trading. Section 4. The Gold Standard, a golden age for currency stability. The gold standard rose in the 19th century. Currencies were pegged to gold. This brought stability to trade. It facilitated trade and investment. Exchange rate risk was reduced. Economic growth and globalization followed. But the gold standard had limits. It restricted government economic management. Countries were vulnerable to gold discoveries and shortages. Section 5. The Collapse of Gold and the Interwar Period. World War I disrupted the gold standard. Countries stopped gold convertibility to fund the war. This caused inflation and currency instability. The interwar period saw economic instability and protectionism. Countries devalued currencies to boost exports. This increased uncertainty and hurt trade. The Great Depression exposed flaws in the monetary system. It showed the need for a new financial order. Section 6. Bretton Woods. Reshaping the global financial landscape. In 1944, as World War II ended, delegates from 44 countries met in Bretton Woods, New Hampshire. They aimed to create a new international monetary system. The Bretton Woods Agreement established a fixed exchange rate system based on the US dollar. The dollar was pegged to gold. The agreement also created the IMF and the World Bank. The Bretton Woods system stabilized the post-war global economy. It facilitated trade and investment. It helped rebuild war-torn countries. Section 7. The Nixon Shock and the Dawn of Floating Exchange Rates. The Bretton Woods system struggled in the 1960s. Rising inflation pressured the US dollar and increased the trade deficit. In 1971, President Nixon announced the end of dollar-to-gold conversion. This Nixon shock ended the Bretton Woods system. the world moved to floating exchange rates. Currencies now fluctuated freely. This began a new era of currency volatility. Section 8. The Digital Revolution. Online trading transforms the Forex market. The late 20th century saw a tech revolution in Forex. Personal computers and the internet made currency trading accessible. Online platforms offered real-time quotes and instant trades. This opened the market to individuals, not just big banks. The digital age boosted Forex trading volume. It also improved market liquidity and efficiency. Section 9. The modern Forex market, a colossus of global finance. Today, the Forex market is the largest and most liquid financial market. It operates 24 hours a day, 5 days a week, across major financial centers. Trillions of dollars change hands daily. Participants include central banks, commercial banks, hedge funds, corporations, and individual traders. The Forex market facilitates international trade and investment. It also influences interest rates, inflation, and economic growth. Section 10. Navigating the Forex market, regulation, volatility, and risk. The Forex market is decentralized and mostly unregulated. Regulatory frameworks protect investors and ensure market integrity. Forex trading is risky due to volatility and leverage. Traders can lose more than they invest. Understanding market dynamics, risk management, and strategies is crucial. Section 11. Understanding the past, shaping the future of Forex. The history of Forex shows the evolution of global finance, from simple trade exchanges to today's complex systems. From bartering to currency systems to online trading, each era brought innovations and challenges, shaping today's Forex market. Understanding Forex history helps modern traders. Studying past trends offers insights for making informed decisions now. It reveals market cycles, trends, and economic impacts. Recognizing past patterns can help predict future movements. As technology evolves, Forex will transform further. AI and machine learning are already offering new tools for trading. New instruments, platforms, and regulations will emerge, providing opportunities and challenges for traders. Core principles like supply and demand, risk management, and global interconnectedness will continue to guide the market's future.